Thank you for joining me. I'm Alex, and we're going to have a look at Synchrony today. And here's a spoiler alert. I really hate them, but they look solid. So, they do banking and credit cards. I've known them for credit cards because I have three cards with Synchrony. Walmart just switched their Walmart credit card to Capital One. But before that, I had 4 Synchrony credit cards. Current price is $33.33, which is gives them a market cap of $20 billion. So, pretty small still. I've had a few that were kind of in the same range, but like a Citibank or Goldman Sachs or JP Morgan Chase are obviously far bigger than that. Current dividend yield 2.65% with a payout ratio of 15.5%, which makes them actually slightly better than LI Financial that I had a look at yesterday. Revenue $16.8 billion, again, very tiny. Earnings $3.7 billion, which is up 34%, which is pretty amazing. Giving them a PE of 6, and they have a forward PE of 7, and obviously the forward PE being higher is a bad thing. But obviously, 34% growth is not really sustainable at this point, and obviously more of a one-time thing. So I assume that's going back down. That's why the forward PE is going up. But the forward PE going up is not as bad as it was 2 years ago. So they're going in the right direction. It's just they're not going in the right direction that fast. Total assets $105 billion. Total liabilities $90 billion, which gives them a total stockholders' equity of $15 billion, which again is slightly better than LI Financial. And here's why I don't like the company. I had 4 credit cards at Synchrony, and they locked all of them. And I was in a terrible financial situation, and I was using the credit cards for cash flow. So buy everything on the credit cards, and on payday make the payments to the credit cards. So I never really had any cash around. And so them just freezing all my credit cards was pretty terrible. And then they asked for a tax return to verify my income, which I sent them. And then after they got that and verified it, they asked for my my paycheck stub to verify my income again, I guess, and didn't unfreeze the cards for another week or so. So really hate the company, but everything looks pretty solid right now. And for a dividend investor, I think this is actually a pretty good company to buy because Dividend is better than LI Financial. Payout ratio under 16% is amazing. The PE of 6, again, like a Citibank, Goldman Sachs, all of those are pretty much double that. And so there is pretty good growth potential here. And obviously things are going in the right direction, so there's that. For a value investor as well, balance sheet looks decent. Banks always have a pretty similar assets to liabilities ratio, so there's never like a 2-to-1 assets to liabilities ratio because they have to borrow everything they're giving out, or they have to borrow the money that they're giving you as a loan so that they can make interest money. So obviously there's no way that they can have a decent assets to liabilities ratio, or rather it would be very inefficient. So for a bank, balance sheet looks pretty good. PE looks amazing. Dividend yield is alright. Payout ratio is amazing. And obviously the growth is pretty decent. So good buy for a value investor, good buy for a dividend investor. Obviously not a good buy for a growth investor because, as you can see, there's no growth for the next year. Where they go from there is anyone's guess, but they actually have a fairly decent market share. They have a lot of pretty big partners. One of the credit cards I had was JCPenney, which is pretty useless right now, I would say. But there's Lowe's, there's Sam's Club still, there was Amazon. So overall, some fairly big partners that they have credit cards with. And as such, I think that this is actually a pretty good buy if you want dividend stock or value stock. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.